In today's video, we're going to do a real quick overview of DSCR loans for Orlando investors. Any investors that have questions, of course, can reach out to us 7 days a week by calling the number there or just visit dscrloansource.com. First, we're just going to highlight a few of the benefits of the DSCR debt service coverage ratio loan for investors. Really, of course, the big draw with DSCR loans is that these loans do not require any income verification in order to qualify. Uh, Investors often face issues with standard conventional conforming loans when it comes to loan qualifying because of the strict debt to income ratio requirements and obviously just income documentation in general. With tax returns and all that, it's often a problem for self-employed entrepreneurs. So the DSCR loan, of course, the big draw is no income verification, meaning no tax returns, not even employment. That is not a requirement with this program. Instead, this loan really focuses more on the cash flow of the property. Uh, Another advantage, of course, with DSCR loans is that investors can close in the name of an LLC or corp, which is great. Most conventional loans do not permit that. They have to close in the individual name, which a lot of investors prefer not to do. And of course, DSCR with these programs, there's an unlimited number of properties investors can have, which really allows them to scale. Most, again, standard conventional loans, they may limit that number of properties and active loans that you can have, depending on the bank or lender, but generally 10 would be the limit. Uh, this is a great solution also for investors that may have a short-term hard money loan that they need to refinance. Um, Oftentimes, we see a lot of investors, again, start out with a very short-term hard money loan, and really DSCR can provide a longer-term solution and also provide a solution to cash out equity, of course, to reinvest. First-time investors are eligible for the program, and again, this includes all regular single-family homes, condominiums, multi-unit. They're all eligible for financing. Of course, all your short-term Airbnb type properties. That is all good with DSCR. Some of the restrictions we want to highlight with the DSCR loan, this is only for investors in really rental properties, short-term and long-term rental properties. Of course, it's not for uh, primary residences or owner-occupied homes or vacation homes. Non-warrantable condominiums, sometimes those can be on really more on a case-by-case basis. DSCR loans, they do have a prepayment penalty with them, and that prepayment penalty, it can range from 2-3 years, but oftentimes investors will have an opportunity to buy down their prepayment penalty lower if they choose to. So there is some flexibility in the length of the prepayment penalty that comes with them. And of course, interest rates are going to be higher with a DSCR loan when you compare it to a conventional loan. It's all about trade-offs. Again, this program's much more streamlined as far as the documentation part of it goes, with no income, no employment, none of that's required. So, with that, really with that advantage comes a slightly higher interest rate, typically 1 to 2 points higher when you compare it with a regular conforming or conventional loan. Okay, investors do need to document their cash reserves with the program. That's just the reserves that are remaining after the down payment is made. Typically, down payments are for purchase loans. 20% down is generally where it starts on purchase loans, and then refinances, cash out refinances, those are eligible to 70 and even 75%. That can and does change, obviously, with the market, especially lately. There's been some adjustments with the market, and as that happens, lenders and brokers, they always tweak the requirements as far as loan to value goes. But back on the cash reserves too, we want to point out that gift funds are allowed for the cash reserves. Typically, though, the actual investor will need, in most cases, a minimum of 5% of their own funds, though, and then the remaining portion can come in the form of a gift from a family member. Again, the debt service coverage ratio calculation, that is the main factor that lenders look at with these loans. And it's simple calculation. You're just basically dividing the net operating income by the total debt service payment. Uh, Most lenders typically like to see the coverage ratios around 1, and anything above 1.25 is considered good. We do have negative DSCR options down to 0.65. So that's important to note, that there are options out there for negative DSCR. But basically, it's just, again, net operating income divided by the annual debt obligation. And again, this includes the principal, interest, taxes, and homeowners insurance of the property, the PITI, plus any HOA fees, if that is applicable for the neighborhood, that would also be included. But again, things like utilities and monthly maintenance, that would not be included in the total formulation. Just a quick example of some basic calculations. Again, real estate investor is going to buy property in Orlando with a monthly rental income of $3,000 and a debt of $2,750. So you just divide that out and you come out with a DSCR of 1.09, and that means basically the property is generating more income than what's required to repay the loan. And again, a DSCR of 1 indicates that the borrower will have adequate cash flow from the property to pay the loan, and then anything greater, obviously the investor will have extra income, and obviously the return goes higher with the higher the DSCR number is. Again, that's a rough overview. Investors that have questions and want to learn more, please visit DSCR Loan Source or give us a call 7 days a week at 888-502-1825. Thank you.